AKB raising the issue of welfareism, and was saying that welfareism is not the takeaway from this election. But I am entitled to revise my thoughts. Like certain schemes, like I was talking to people, like with keeping in mind the Haryana election, the Agniveer scheme may be tinkered with or rolled back. That would have financial implications. Similarly, a BJP minister can continue to have all the infrastructure and finance ministry and railway ministry, but they will have to take on board the views of the allies, especially TDP and JDU. So it has to be, the approach has to be one of consensus and taking everybody along, which is where this government needs to walk the talk depending on what the ground situation and the arithmetical reality in the parliament is. That's the
Mr.
big
Bhattacharya,
challenge.
sure, Mr. Bhattacharya, if you could come in on that, sir. I mean, even if, let's say, what Mr. Srivastava is saying, even if the minister continues to be a BJP candidate in some of these key ministries, will the allies still have a much greater hold, a greater sway and say in areas like finance, in corporate affairs, in railways and infrastructure?
Well, I broadly agree with what Mr. Srivastava has articulated right now. But I would like to add and maybe modify the proposition that you put forward, that I don't entirely agree that it will be the continuity that will be watched closely. Because if continuity were to be the main yardstick of judging the new government, I would say both the markets as well as the nation and the citizens and the voters would be a little disappointed. Because it's important to note that in terms of key reforms or the key important steps that will bring about greater efficiency in the economic system, the last 5 years have not seen any except Air India. There was no other privatization. So when you say about continuity, are you talking about no privatization in the next 5 years? Now that will be a disappointment. If there has been no movement on the labor reforms front. Now, would you be happy with this continuation of no further reform on labor front? There has been no further movement on the well thought through farm sector reforms. Now, I think the idea is not to only see that whether the government is of continuity, but whether the government takes the necessary political risks or use its existing political capital to bring about the much needed reforms in key areas as what I mentioned. So I think it's important to have ministers who are in charge of key economic and infrastructure ministries, but at the same time, those ministers should be empowered. And if that empowerment means that the railway ministry goes to an alliance partner, so be it. So I think it's very important that continuity of the kind that we saw in the last 5 years is not continued, so to say, and we see more reforms in these areas. I mean, there is a policy of the previous government that non-strategic PSUs will be privatized. There is a policy of asset monetization. Now, the question is, if we are happy with continuity, then I see an area of concern that continuity would mean no privatization, no further push to asset monetization, no labor law reforms, no farm sector reforms. So I think that is very, very important to keep in mind.
That's well put, Mr. Bhattacharya. Now, but by the way, we were talking about this welfareism. I was looking at the CSDS Lokniti data. BJP's vote share among the poor actually has gone up. So, and this kind of goes back to some of the points we were talking about earlier about, whether there'll be a change in stance or, and whether there'll be more sort of helping the masses and stuff like that. I mean, the data shows otherwise. Anyway, Mr. Bhattacharya, just, without tackling some of these more contentious issues, are there specific areas, do you think, where we can see a thrust from the government? Could housing be it? Is there one or two areas that you would like to identify where it's possible? Yeah.
Taking off from what you just now mentioned about the CSDS survey, I think there would be a more refined approach to welfareism in the sense that if you believe, and I do believe, that this government is fiscally prudent, in the sense that it has not really used its resources. It has used its resources in a manner that the fisc by and large has been kept safe, although the overall target and trajectory has not yet been met. Now, so therefore, there would be some refinement in the welfare schemes by which a better targeting with the use of technology in the delivery system through the digital public infrastructure, that is possible. Mr. Srivastava talked about tweaking the Agniveer scheme so that the big shock that the BJP probably received in the way the Agniveer scheme was received in states like Haryana, states like Himachal Pradesh, which produces a lot of these soldiers, and
Rajasthan.
they were Rajasthan also. So I think it's possible that the Agniveer scheme may be tweaked, but I would hope that all those welfare schemes that are tweaked and made more focused do not bleed the fisc, because please remember that while fiscal consolidation has to be the primary task, it is also equally important how you use the extra money that the government has received from the Reserve Bank of India, which is almost as large as 0.37% of GDP, should be used more efficiently, effectively, and bringing about faster growth, creating more jobs, and ensuring that the kind of iniquitous growth that we have seen with the top half of the economy doing well faster than the bottom half, those issues are addressed.
Yeah, absolutely, gentlemen. A valid point, and I think that additional cushion of 1 lakh crore rupees from the Reserve Bank of India, that would be very, very timely, and it'll be very interesting to see how the government puts it to use, and we'll have those answers come the budget. Thank you for joining in. Of course, we'll keep coming back to you. Hope to have more of these conversations as we know.
Once we have the portfolio allocations, Mr. Bhattacharya and Mr. Srivastava, I hope to have both of you back, and we're expecting that any time now. So. Hopefully, we'll be able to speak with you and get your reactions once we have that. Thank you for joining in. I think the market, by the way, is sort of be absolutely flat. Nothing. 3 or 4 point change. 23,300. Let's get Mitesh in for a quick word. Mitesh, what are your observations on the price action? The big sell-off from the day's high.
So I think Prashant, looking at the hourly chart, we failed to actually get past 23,307, which was the last time we had been here. I think after this big rally from 21,800 hitting the earlier high, just taking some profit booking, I'm not really worried. Would be a buyer on declines. Let's say if you get it closer to about 23,150 on this spot, which is 140 points lower, then try and add on to long positions. Having said that, on the stock side as well, have a buy on ACC. That's doing very well. So ACC, I would recommend taking long positions, keep a stop below levels of 2518, 2517, and target of 2630, 2635 on the upside is what I'm looking at the minimum. Eventually, we may even look at higher levels from there. And the second stock, which I like, that's also a buy call, a buy on Britannia. It's a conditional buy. It's been consolidating for the last 4 or 5 days. Once it starts getting past 5475, 5480 zone, buy with a 40-50 point kind of a stop and look for a target of 56.
All right, Mitesh, good speaking with you, and thank you very much for sharing those ideas with our viewers as well. Appreciate it. Well, we'll just take a quick commercial break here. We put the focus on commodities. Precious metals have sold off, but is that top of mind for Manisha? We'll find out in just a bit from now.
That in fact, that high cost inventory will be out of the way. And if you just look at the margins, well, they've come down drastically to around 5% in comparison to around 11% odd. So both of those are the triggers that are going to be working for it. And that's why the margins are expected to improve from here. And that's why the EPS as well is expected to move from here. Well, next up, let's move to Amara Raja. You have Mr. Gala, who was a TDP member. He was also a member of parliament from Guntur. This time around, he wasn't, standing for elections from out there. But in fact, there is that bit of the TDP play, so to call it, for Amara Raja. Besides that, besides the core business, they're also talking about cell manufacturing facilities. And the cell manufacturing facility, well, that's something that is likely to come on stream in the second half of FY26. The capex that they've laid out is close to around 1,200 crores. They're talking about an asset turnover around 1.3 to around 1.4 times odd. So that's going to be the key trigger fundamentally that we're looking forward to. In terms of valuations, the stock has gone up big time, but it still trades at around this 24, 22 times odd. So that's on the valuation chart. Moving to the cement and the infra themes then. The street believes that Mr. Naidu is pro-development. And because he's pro-development, cement will do well, construction as well will do well. So there is that pro-development agenda that's likely to come. And remember, when he was last in the hot seat as a CM, Amravati, that was the capex plan that the street was looking forward to. But when he lost the elections, well, then that complete plan went out of the window. So they're hoping this time around as well, the Amravati big capex plan will come on stream again. And because of that, you've seen stocks like KCP, you have Ramco, Sagar Cement, all of them, well, that's their capacity that they have in Andhra Pradesh as well as Telangana. And that's the percentage of their total capacity. So as you can see the bottom of your screen, these three companies, in fact, 80 to 100% of their capacities are in this region. So they could stand to gain. The other couple of names, NCCA and KNR Constructions, both of them saw a big rally this week. A lot of factors out there, but just to highlight three factors. One is that Amravati capex plan that we're talking about. There were also some pending dues that didn't.
Welcome back. All right, let's quickly get back to Manisha and figure out what the top commodity cues are. Manisha, so what's top of mind for you?
Oh, well, all the metals actually will be, because we have started the month of June with a bit of a decline here. April and May saw strong gains, but we seem to be looking at a halt in the rally right now in many of these commodities. The latest trigger clearly has been the US non-farm payroll data, the highest in 5 months, and more than 200,000 jobs there. Markets were anticipating something like 160 to 190,000 there. So that clearly has been one of the reasons. And with that, the possibility of a Fed rate cut in September now has declined from a 68% in the previous week to 55%. And that one rate cut perhaps could happen in the month of November is what the most bets are suggesting. So I'll start with the gold prices, which have now broken below $2,300 an ounce. The all-time high has been $2,450. The month of June actually until now has been on a declining spree, and we are trading at a one-month lows when it comes to the gold prices there. Also, markets have seen China demand in sense of central banks see a pause in the month of May. China Central Bank has been buying gold for its reserves for 18 months, and that did not happen in the month of May. That has also led to a bit of a profit taking there. Silver as well fell 4.5% in the previous week. We're looking at a one-month lows onto this one. Not just that, the crude oil prices also have declined 2% in the previous week, and third week of losses is what we've seen onto this one as well. Copper, for that example, also fell 4.5% in the previous week, and this is after 10% gains in the month of May. Here as well, we are way off all-kind highs that we saw in case of copper there. Take a look at the steel rebar prices, and we are trading at around 2-month lows on to this one. 34.50 Chinese yuan per ton is where the steel prices are right now. There is weak demand in China. The home sales for the last couple of months have been declining as well. What the street will watch out for now is the Fed rate policy. Well, that announcement comes in on Wednesday, and so does the consumer price index numbers as well. So Wednesday is going to be quite important in sense of dollar and movement for many of these commodities.
All right, Manisha, thanks very much for that. That's Commodities in Focus. More with Manisha as we go on. We'll take a break. Our special segment is the economy. My colleague Lata will get chatting with Santanu Sengupta, Chief India Economist, Goldman Sachs, to put the focus on the RBI decision to maintain status quo, repo rates, and, of course, RBI's growth forecasts, which now are up. Stay tuned.
It believes this time around they'll get cleared out. So pending dues will get cleared out. And besides that, you have the fresh orders that could come about. So you have Heritage Foods, where he is the promoter entity. Amara Raja, there's a bit of a TDP connect out there, and there's a fundamental reason as well. And cement, as well as infra companies, they could stand to gain. Undoubtedly, the MVP of the last week was Mr. Chandrababu Naidu.
Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. The GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. The risks are evenly balanced. Private consumption, the mainstay of aggregate demand, is recovering. And it is recovering with steady discretionary.
Left interest rates unchanged and gave no hint at all about the timing of a rate cut. The fact that it has upped the growth forecast may mean that rate cut is not needed because growth is strong. More important, however, Reserve Bank said in the press conference that it will release its view of the neutral rate in the next bulletin, RBI bulletin. Now, what's the neutral rate? It is the ideal difference between the nominal interest rate and inflation. With the current repo rate, that is the nominal rate, at 6.5%, and CPI forecast for this year at 4.5%, the real rate difference is 200 basis points. But if the RBI thinks that the neutral rate is 150 basis points, very much for joining us. I just had to give the preface because neutral rate is not something we speak about very often. But what's your best guess of the cut? Are you on mute?
Sorry, thanks, Lata. So we think that the neutral, in our view, is somewhere around 6% for India, and therefore the real neutral is about 150 basis points. This is higher than what you've seen in the past in the region of 80 to 100. And therefore, we think that you can still have the quantum of cuts in India will be determined by the neutral rate, and which we think still is going to be only 50 basis points. The timing of the rate cut by the RBI still remains a difficult question, as one, growth remains strong, and along with sticky trajectory of food inflation might mean that some of the RBI MPC members may be reluctant to pivot immediately. But our call still remains that you go in Q4 of calendar year this year. It's a toss-up between the October or the December meeting, in our view. We think it's slightly more leaning towards the December meeting if you see that food inflation is sort of contained by then. And core inflation sequential momentum is also not as strong in the second half as you head into the end of the year.
Okay. I'll come back to the rates position and the fiscal connection in just a minute. But the other big takeaway from Reserve Bank was the increase in the GDP forecast for the current year, or GDP estimate for the current year. You already upped it by 20 basis points, your forecast. After what you heard from the Reserve Bank, or because the government is not what we thought it would be on 31st when you were making your forecast. It's a less, it's a lesser majority than we thought. Do you want to tinker your growth forecast either ways? Or is there an upward or downward risk to it?
So we are at 6.8% growth for the fiscal year 25. The calendar year is slightly higher, and basically the fiscal year is low because of the very high number that you got in the previous quarter. Look, for the cyclical growth view, we think the risks are fairly balanced. So I don't really think there's a major upside risk to our growth forecast, especially given the fact that we are still baking in the fiscal consolidation. Even after the election outcome, we think that we are still going to go towards 5.1% of GDP, or they'll try to slightly better that, maybe at 5% of GDP in terms of the fiscal consolidation. And then if monetary policy also remains tight, in our view, at least until October or December of this year, then and monetary policy works with lags, then you don't really have a cyclical fillip coming from the policy side to raise growth forecasts. Now, would the private sector capex cycle be markedly stronger than what we are anticipating now, which could raise our growth forecast? That could be an upside risk. But otherwise, I would not really, I would think that the risks are fairly balanced around our forecast right now.
Okay, but let me just push you a little bit on that. some have read the election verdict as an indication that several pockets are dissatisfied, that the K-shaped recovery has hurt large segments, which is why you saw in Uttar Pradesh, Rajasthan, Haryana, the ruling party performing badly. So would you expect, say, higher MSP or some other kind of largesse, which may disturb the fiscal numbers, but which may be positive for growth as well?
So, Lata, again, from the macro perspective, the aggregate fiscal impulse is what matters. And within that, what is the mix of consumption versus, let's say, investment, right? So we think that the aggregate fiscal consolidation towards 5 or 5.1% of GDP remains intact, especially now that you have the buffer of about 30 basis points incremental from the dividend, from the incremental dividend from the RBI. Now, could there be a switch towards more welfare spending as you head into the second half of the year? That's possible, given some of the election, how you interpret the election outcomes. But that necessarily would not be incrementally positive for growth, because the aggregate fiscal impulse still for us, would remain intact, because you will have to shave from somewhere else to provide the fillip here. I think the upside risk again is coming from a capex cycle if it really picks up much faster than what we are anticipating.
Okay. Well, I would still wait and watch for whether there are large state packages. After all, in the portfolio, we still don't know the portfolio, but it doesn't look like the plum portfolios are going to the allies, in which case they have probably been promised or are expecting state packages. But anyway, that discussion for another day, we would know it shortly. I wanted to get your view as well on, the US non-farm payrolls, indicating that, the Fed perhaps is not cutting anytime soon. The yields have risen. I don't know if you are the point person to tell us what is the Goldman Sachs view on yields in India. Will it be like, continue to be between 6.95 and 7.1? What is your yield expectation average for the year? And rupee, more importantly.
Yeah, so we do not put out forecasts on the 10-year benchmark bond in India, but what we like, because of our view on monetary policy, and we are baking in rate cuts in the later half of this year, is we like the short end of the curve. So we have a standing recommendation on a long 2-year IGB. And the main reason is because the curve, if you see in India, is now really flat. And if you think that the neutral rate in India is around 6%, so the RBI can ease up to about 50 basis points, which is our view, then the short end at some point of time is what we think will rally more than duration, and therefore we like to be in the short end. On the rupee, even with the election outcome, etc., we don't think that with the reduced majority, the macro stability which India has earned in a hard way over the last 5 or 7 years, that is getting, that is going away. We still think that the current account deficit will be narrow. We still think that the fiscal consolidation will be maintained, and inflation will remain within the target band of the RBI. And therefore, we continue to like the rupee as a low-vol carry currency. We have a short euro and our trade recommendation.
Okay, got that. So rupee appreciation, or rupee at least not depreciating much. Shantanu, you had an excellent report on India's savings and investment. I can't do much justice to it. But from what you are saying about rising financialization of savings and more money going to insurance, the trend you said 15% CAGR over the last few years, are you suggesting that there is a longer-term rally in the bond market, one, because interest rates are likely to remain subdued, fiscal is likely to remain subdued, and secondly, are you seeing the rise of a corporate bond market in India for the longer term?
Yeah, so look, we think there are two implications of this. Well, broadly three. One is that the capex cycle domestically should get funded with the savings that you're generating, and that reflection is in the current account. But 2 and 3 are quite important. Second point is that you're having duration savings in India through pension and insurance. And that is anchoring the long end of the yield curve. So if you see from the 10-year point all the way up to 40, it's a pretty anchored and flat yield curve. But you know that the government is also going to consolidate at the same time over the next several years, which means that you're having the savings flow and the safe security supply consolidating, which means that this money has to get channelized somewhere else. We think that the appropriate one will be probably the quasi-fiscal balance sheet or some of the corporate bonds through PPP partnerships, which should be able to continue the infra financing in India, because infra financing wants duration savings because that's the kind of ALM that they want to run, right? Their assets are long duration. The savings also would want to be long duration. And therefore, we think that at some point of time, this savings from the SDLs and GSEC, some of it will start getting channelized towards quasi-fiscal as well as corporate bonds over the medium term.
Okay, but that's extremely positive from a longer term productivity angle. Longer private savings going into infrastructure as well as fiscal consolidation. So very quickly, Shantanu, would you want to take a jab at longer term growth? All these are productivity inducing, higher capex, higher infrastructure, higher savings. Do you think that we are in for a long innings of 7%? What's potential growth?
So our estimates of potential growth in India currently is somewhere in the region of 6 to 6.5%. We think by the end of the decade, you're probably heading towards somewhere in the region of 6.5 to 7%. But one of the key assumptions that we had made was that the key structural reforms, which are difficult to implement, would come through. One being land, two being the farm sector, and in some ways, the farm sector and land reforms go hand in hand. We'll have to see with this coalition government whether we are able to pass these structural reforms. If that comes through, we think that the 7% potential growth on a sustainable basis is very much possible. If not, we think that India's growth rate is somewhere in the region of 6.5 to 7% from what we are seeing.
Okay. All right. We have much to know from even the perhaps portfolio composition, which I think we will get. We just ran pictures of Prime Minister Modi cavalcade going towards for taking over as, reaching South Block to take over. Shantanu, thank you very much. We'll have a better discussion at a later date after we know how things are panning out at the government end. Very important to know portfolios, but we could be in for something strong. Besides, the Reserve Bank Bulletin will also give us the potential growth number. We await that. Wrap up on Bazaar on that note. Chartbusters up next, and then there can be, of course, a lot of news from Delhi as well. Thanks much, but stay tuned.
In urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in
Very good morning. Welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. We have started on Monday. We've started on Monday in style. The Nifty continues to hold in the green with a gain of around 60 points odd. Mangalam, we've got a couple of managements. Let's get straight to it.
Let's get straight to it. It's a good day. So let's get in the management of JSW Energy to understand the power sector, the impact of the elections in the power space. JSW Energy, Sharad Mahindra, who's a joint MD and CEO, joins in to take a few questions. Thanks a lot, Sharad, for joining in. With the formation of a coalition government, do you expect to see a change in policy in terms of the power space? What's your wish list for Modi 3.0?
In fact, in power space, with whatever we have seen has happened in the past, there's a recent elections, the outcome, we strongly feel that whatever the way the country's economy is growing, we don't expect any change in the growth path for the country, because a lot of work, if we see, is in work in progress. And the way, especially talking about the power sector, which is driven by the, in general, economic growth, which is driven by the various growth in the infra sector, we don't expect that there will be any significant change in the dynamics, what we have witnessed, especially in last 2 years. Especially when we see last year, the significant change and the milestone which was achieved was that country's ambitious target of adding 50 gigawatt of renewable energy every year. Last year was the first year when the bidding and the outcome and the award was in excess of 40 gigawatt. And that all has to come on ground in next 2 years, 3 years time. So we don't see, and the way the power demand growth we are seeing, what we have witnessed, especially also the extreme weather condition, we are quite confident that the same growth pattern will continue, and we don't see any significant change or any change in our growth strategy going forward next 5 years.
All right, sir, the power demand supply is still a concern. Evening peak demand is unable to be met by solar power demand. So what trust do you see towards renewables?
As you rightly said, that the peak demand, when it reaches in the evening, and it has been a challenge meeting the peak demands. So there, plain solar, plain vanilla is not going to be the ideal solution. That will not be able to meet the peak demands. So that is where the customized solutions, which are coupled with storage, to give the green power, is the thing which we are seeing that is taking shape. And we are sure that along with solar and wind, it is the storage which is going to play a key role. And countries breakup, if you ask for 50 gigawatt, this is basically a breakup between wind and solar energy. But along with that, coupled with storage, and we have seen some of the FDREs bids also have started taking place. Some states have come with plain storage bids also. So that is which is going to gain a momentum in this year and going forward also. And we at JSW are in line with this growth plan which we have. We have done the study, and that is the reason that we have already started now one of the largest, Asia's largest battery energy storage project. The work at ground has started. And we are confident that by June 25, this large capacity of storage, energy storage, will be commissioned.
All right, energy storage is one of the big thrust areas for you going forward, and you see that being commissioned by June 2025. What about your own green hydrogen plans? I mean, what's in the kitty so far? What's been the capex? When does that come on stream? And will it be, only used for captive consumption, or there is some, other revenue that you can generate via it as well?
Yes, I think we have just started again the groundbreaking, and the project work has commissioned just about 10 days back, which is country going to be, as on today, the country's largest green hydrogen project, which is 3,800 tons per annum capacity with 25 megawatt of solar capacity. This work has started. And this is basically, we are confident we'll be commissioning in the current fiscal, Q4 of current fiscal only. And this is basically to take care of the JSW Steel, our captive requirement, because JSW Steel is also venturing into green steel. So this will be a major step in that direction. And also, this will be a big learning both for us as a supplier and also for our group company to use green hydrogen in steel making. And as we have already signed a MOU with for captive requirement of almost 90,000 tons per annum by green hydrogen by 2030.
All right, so Bihar has high power purchase costs that in comparison to the national average. They are likely to push for MBED. What would this mean for JSW and the power space as such?
See, when we talk of, we have heard also that one nation, one tariff policy, which the state has already made the statement. See, this is something which is have been under discussion for quite some time. And what I feel, seeing the distributed usage pattern also for each state, because Bihar is majorly a agriculture-driven economy, the usage pattern there is significantly different when we compare to other states like Maharashtra or Karnataka or Tamil Nadu, which is manufacturing percentage to the overall state economy is high. So I think one nation, one tariff discussions will happen. I think there are definitely challenges to arrive at a consensus, and we feel that it will still take some time to arrive on a decision for this one nation, one tariff policy.
All right, that's still some time away, according to you. But what's your view on the likely price caps on both variable costs on power sold on exchanges? Do you have significant untied merchant capacity?
See, with the way the power demand is growing, and we are seeing the kind of peaks we are seeing, especially in the evening peaks and the morning peaks, and during the daytime with the increased solar capacity addition, which is happening and will continue to happen, definitely there will be excess power available during the daytime. That is what the scenario is likely to be. So, but evening and morning peak demand, the capacity addition is required. So that is where what we have decided is the storage is going to play a key role when there is excess power and the power cost is low during the daytime. That is the power which will be used for storage to take care of the evening peak requirements.
All right, so RBI mentions that higher provisioning will be needed for infra and power projects. Do you see tightened funding environment?
No, till now we haven't experienced anything, and I feel that again it will depend sector also or companies also, and also the records of execution. So we have deliberated. We don't expect any impact on us because of our track record, because of our healthy balance sheet. We don't expect any impact on us.
All right, and what about merchant prices? How have they panned out, and how do you expect coal prices to move from here?
See, one is that merchant prices, as we said, on a RTC basis, we are seeing a slight moderation, and that is only because that during the day when the solar power is available, the tariffs are down, but mornings and evening peaks and the night power requirements, the rates are high. So on an average, we expect the levels what we witnessed in the range of 5 rupees 30 paisa, 40 paisa last year, it will remain in the same range. And coal prices, if we see, have been quite stable for last 6 to 8 months, and we don't foresee any major change in the coal prices, and it is expected to remain range bound.
All right, so at the end of Q4, you had mentioned that you're open to both organic as well as inorganic growth plans. Any acquisition targets that you've identified? You've taken 10,000 crores of enabling provision as well, so you're bracing yourself for something big. Tell us more.
When we say that whatever our greenfield capacity additions which are going to take place, we have earlier announced of reaching 20 gigawatt by 2030, as I have said earlier also, and 10 gigawatt by 2025 in the current fiscal. So in the first phase, we are absolutely confident, and we'll definitely be crossing the first stage of 10 gigawatt before the end of the current fiscal. So that stage, what we have said is happening. We are absolutely sure because the work is already happening. Work in progress is there. And in addition to that, 20 gigawatt, what we have set by 2030, as said earlier also, we are quite confident with the kind of order book which we have built by participating in the competitive bidding space. It will be happening significantly earlier. So this is one, definitely we are sure that our plans, we will be achieving 20 gigawatt numbers much earlier than what we have stated earlier.
All right, it'll be good to know that you will be meeting your guidance, at least for the first phase, much earlier than what you had stated. What about the acquired in Bharat Unit 2? Has that been commissioned in the first quarter? What would be the EBITDA contribution, and any update on the WTG manufacturing?
See, in Bharat Unit 2 commissioning, as I have said in quarter 1, the work is in progress, and we are confident that this will be happening within this quarter, or depending on, again, the stabilizing the unit and all, maybe 1 or 2 weeks here or there. But we are absolutely sure as of now that by month end, because the light up has already happened and the unit is stabilizing, whatever it takes will take, and we are sure, quite confident that by quarter end, or otherwise the spillage maximum will be for maybe few weeks only, between June and July, that the unit will be commissioned. And being again low cost power, being close to the mines and the pit head plant, again, this will again, as we have seen in Unit 1, the contribution from this side, the EBITDA are going to be quite healthy.
Let's appreciate you joining in and filling us in with all of those details. Look forward to chatting up with you as the quarter progresses. Well, for the time being, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Madhuchanda Dey of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about Safari Industries that underperformed in recent times after a stellar show in the past year. FY24 financial performance was, however, very strong, with the company clocking revenue growth of 28%, which was much higher than competition, thereby indicating market share gains. The company also managed to improve its gross margin as well as operating margin. Hard luggage, which is sourced in-house, has already touched 65% of overall sales, and the company is now embarking on capacity expansion. This expanded capacity should help Safari in staying price competitive and should have a positive effect on its operating margin as well. The company is foraying into premium segment through its brand Urban Jungle. This change in product mix is also positive for its margin. Travel as a mega trend is here to stay. The luggage industry is witnessing a shift in favor of branded products thanks to rising income and increasing urbanization. The replacement cycle is also getting shorter. While Q1 FY25 is expected to be a little softer quarter thanks to the heat wave and the elections, we see this consolidation phase as an opportunity to buy the stock for the long term.
All right, Madhu, thanks a lot for that. With that, we'll slip into a short break. On the other side, we have the management of Exigo Travels, Alok Bajpai, the co-founder, and Rajneesh Kumar, who's the director and group CEO of Exigo, to discuss their IPO, which is open for subscription today. Stay tuned. Welcome back. You're watching us here on Chartbusters on CNBC TV 18. Let's talk about the primary market action. The IPO that opens up today for subscription is that of the online travel agent Travenews Tech, more popularly, of course, known as Exigo. Its IPO is open for subscription. It's a 740 crore IPO, which consists of an offer for sale for about 640 crores and fresh issue of 120 crores as well. They've raised about 300 crore plus from anchor investors. Alok Bajpai, who's the director and group CEO, and Rajneesh Kumar now join in to discuss the company's post-listing strategy. Thanks a lot, gentlemen, for joining in. It's your day one on D Street, seeking funds from investors. Let's talk about a couple of things when it comes to your numbers and growth plans going forward, right? I was looking at your revenue CAGR over FY21 to FY23. Of course, that was skewed by the pandemic. So the number is close to around 64%. So what we want to understand is what's a sustainable growth in your top line from current levels, and what's the kind of margin band that you would operate in? I think, Alok, you're on mute.
Apologies. Even if you look at our revenue pre-pandemic to now, one of the things you'll notice is that Exigo was the fastest growing OTA in India between FY20 and FY23. We grew at about 350% in that period. So it's not just the coming out of pandemic part, but I think the fact that Exigo, which started as a utility app focused on solving for customer experience across trains, flights, buses, and now hotels, transitioned to become an OTA just pre-pandemic. And what you're seeing in terms of resurgence post that is essentially our large base of users actually starting to transact with us and starting to show up on the revenue and the top line as well as on the bottom line. I think if you look at the overall market, right, travel in India is going to be a 5.9 lakh crore industry across train, flight, bus, and hotel in FY28. And a large part of that, almost half of that is going to get done online. Now, in terms of our growth and potential, I mean, we are the market leaders on the train OTA segment, the second largest on the bus OTA segment, and the fastest growing one on the flight OTA segment. The overall OTA market is going to grow at around 18% as per the Frost & Sullivan report over the next 4 to 5 years. But I think in the past, historically, you can see that we've grown way faster than the market.
All right. So how much faster than the market can you grow? And by virtue of that, what could your market share be? It's a little over 6% right now.
So I think that's the aggregate market share on a GTV level. But if you look at the individual categories, right, on trains, we have a market share which is upwards of 52% in the OTA market. On the buses side, we are at about 12.9% of the OTA market. And on the flight side, we would be at around 5.3% of the overall market. This is the 9-month FY24 data. Now, if you look at the growth, right, the prior year on flights, we were at 3 and change. And you look at train also, we've grown from 46% to 52% on buses as well. We have grown from 11.5 to 12.9. So I think we continue to gain market share in all the categories we operate. In terms of penetration, because buses and flights, we are under-penetrated compared to the train category. I think there's strong growth potential that we foresee there. And hotels, we're just getting started. We launched in December.
Okay. All right. Hi, gentlemen. Good morning and welcome to the show, both Rajneesh as well as Alok. And wishing you all the best. And me and Mangalam, as well as the entire team, will look forward to chatting up with you as the time progresses. Want a couple of details with regard to your business. How do you see the revenue mix currently? And how do you see it, say, in the next couple of years, the transformation of your revenue mix? Give us a rough number.
So I think as you would have seen that we have very recently gone into hotels, right? It's been in December last year. And these are very early days for us. But if you look at our revenue, how it has been evolving with time, we have had a head start in trains, right? So without making any forward-looking statements here, all I can say is that as our products keep evolving over time, I think some of these revenue mix might change over time because our head start on trains is what got us to like this market leadership position on trains. Because as you would have seen, the playbook of kind of solving for core customer pain areas on trains. We didn't start with ticketing, which is important to note here. We started by solving some of the core customer pain areas within, train as a vertical. And then, 2017 is when we started train ticketing, right? And then, flight and buses, we became OTAs later. And hotels, the entry has been very, very recent, like I said, in December last year. So, what we have seen so far is that this playbook of solving, for customer pain areas first, and then kind of driving organic traffic through that. So you would have seen that, 90% of our traffic is organic. And the reason for that, obviously, is that when you solve some of the customer pain areas and you're extremely customer-centric, we're able to kind of drive a lot of organic traffic.
Got it. Rajesh, let's try to get a couple of broad band numbers, which is totally in line with the regulation. So don't worry about that, because we're not asking you for exact growth numbers from here on. On listing, we'll push you for that. I wanted to understand, how much of your expected share of your revenues can come in for hotels. As you said, you just started making an entry out there. So where do you see this number headed in the future? What's the aspiration? And also, how much of your revenues should come in from ads?
I'll take that one.
Please go ahead, Alok.
I think what you need to understand is that our playbook in terms of who we are targeting is very different here. Now, most OTAs in India that started about 15 years ago were targeting the flight first kind of customer and then monetizing from hotels once that customer was onboarded. I think Exigo has a very train first approach, and that is because we believe that the average user in Bharat, or in tier 2, tier 3 cities, aspiring middle class in tier 1, trains is still the dominant mode of transport. Only 4% of Indians actually even take a flight, right? And I think from that perspective, our playbook in terms of selling categories like flights and hotels is very simple, that once we have sticky users coming to us for booking flights and buses, we are able to upsell categories like flights and hotels to them opportunistically. When an airport opens up in a town, we've seen, and we've declared this time, the numbers, we've seen the growth of flight bookings from our NBU users almost grow 90% year on year in FY24 versus FY23. So and overall flight GTV growth has been 80%, whereas the market grew at in the 20s. So I think the same playbook we are going to apply on hotels, which is to say, what does the person coming from Bhopal, from Kanpur, from Ranchi,
right,
or from Jaipur desire when it comes to a hotel booking or accommodation booking, and we'll solve for that.
All right. So then final question before we let you go. We'll push you a lot more for numbers and growth estimates, etc. once your list. A large part of your revenue, of course, comes in from the train business. And one of the risks is this increase in IRCTC charges as well. So when does this contract typically come up for renegotiation?
So see, this is a contract which is governed by a policy. There's a B2C PSP policy that IRCTC has, which governs their relationship with all OTAs. It's a uniform relationship with all OTAs that they work with. It's not an exclusive arrangement that we have or any other OTA has. And our contract has been renewed already till FY28. And typically this is renewed under the policy. So I don't foresee a risk there of any sort. And I want to guide one thing that is very important for your viewers to understand, that look, from IRCTC's perspective, right, this is a synergistic partnership wherein we are helping them distribute train tickets to every nook and cranny of India, and bringing on board the first-time train bookers that sometimes come from small villages. We have 2,481 towns from which we get transacting users. In terms of split also, you must see that revenue-wise, though train appears as more than 50%, when you look at it at a contribution margin level, which is something as a disclosure only we provide at this point, the train contribution margin contribution to the overall pie is about 45%, whereas flight and bus are 55% cumulatively. So I think that pie on the margin level has evolved a lot in terms of diversification and will continue evolving there.
All right, we take your point, and we'll push you for the numbers as well. 3,600 crores, the market cap that your guys are seeking post listing, which implies that 5.5 times price to sales is what you're asking for at the end of FY24, annualizing your 9-month numbers. That's pretty much in line with Yatra, but a steep discount to Ease My Trip. But that's also because of the big margin differential that there is. But on all of that and more, the next time. Thank you, Alok and Rajneesh, for joining in. With that, We'll step into a short break, come back, get you more on the markets and a lot of stock-specific action. Stay tuned.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and CNBCTV18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and listing.
Welcome back. Well, most markets are trading in the green this morning, which is good news. The Nifty is still holding with a gain of around 50 points. We've come off a little bit from the top. The Nifty Bank is up 50 points odd. I think all the indices that I'm looking at, they're either up between 50 to around 80 points. So a bit of consolidation is what we're seeing. But just to pull up a few stocks for you on the screen, Heritage Foods, the stock was up close to 10%. That big bounce has got sold into. So, that stock should come up for you on the screen. KCP is the other one as well that was up close to around 10%. So remember, these are stocks that moved 40% in the last 4-5 sessions. That one as well as almost in the red as we speak. You spotted a few, Manglam?
On Heritage Foods itself, Nigel, it's doubled in the last 12 sessions. So maybe some profit booking can't be ruled out. So as you pointed out, those are a bunch of stocks which we are watching out for. We wrap up on this edition of Chartbusters on that note, and the team of Trading Hour will take the market action forward. Thank you for watching.
Key news makers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on the large street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage.
Hello and welcome to Trading Hour. It is Monday, 11 a.m. and we are here with all the Qs. I'm Surabhi Upadhyay. With me is Hormaz. And Hormaz, I don't know about the political circles, but 400 par happened. 23,400 was crossed in the opening trades. So the market did make all-time highs and there was a cool-off that came in. And right now, the buying has come back in. So what's very, very clear that this remains a bit of a buy on dips market because the dips are getting bought. That's the important point. And in terms of sectoral participation, it's a complete mix today. You've got economy facing stocks doing well. You've got something like a Nestle, which is consumer, Britannia, which is consumer, that's doing well. There's been some buying on the big blue chip names like Reliance, like State Bank of India. So there's plenty to keep the green side of the screen fairly active today, Hormaz.
The question is how much of a dip is too much of a dip, right? Yeah. Because the dips that come around 20-30 point dips and they get bought into. But yes, if the market is doing well after making 23,400, slipped into the red slightly, but par for the course, I guess, considering the week that we had the last time around, right? We have making record highs, then losing biggest single day drop in 4 years, losing 30 lakh crore in market cap, and then recovering all of that in the next 3 sessions. It just sums up the state of the market that we are in. The broader markets also are doing well. The PSU banks are doing well. Real estate is doing well. So as Surabhi just highlighted, it's a broad mix of stocks and sectors that are doing well in today's trading session. There you can see the PSU bank index up 1.5%, as is the realty index as well. PSUs in general are also doing well. Power Grid is the top Nifty gainer in today's session, is up 4%, as is Ultratech. Cement stocks are doing very well in today's trading session as well. But we have Unmesh Sharma to start the show with. He's from HDFC Securities. He's joining in to discuss some market fundamentals as well. Unmesh, good morning. Thanks a lot for joining in. What do you make of this market, Unmesh? How do you approach a market like this? Because you are up 3% one day, down 6% another, then up another 3% the next day. The retail investors made the most of this fall. But do you think now it's time to take a bit of a pause, or do you think that there's still more steam left ahead?
Yeah, good morning. I think if you had gone to sleep on Saturday and woken up today, you would have realized nothing's happened at all. I think it's interesting to see how all of this has played out. But in any case, I think the fact of the matter is that this volatility on a daily basis should reduce going forward. One key thing being whatever speculation there was about the formation of the government and all seems to have been put to rest now. Very clinical and efficient execution by the ruling party in that sense. Okay, so all from a market perspective, it's back to business as usual. I think with the exception of a little bit of consumption and rural kind of focus, which is incrementally happening, we see absolutely no change in the way in which the government will approach either the public finances or the sectors on which they are focusing. So it's very similar to what we would be saying last week, for example. On the large caps, there's a little bit more value, but that is also where the price discovery is happening because the FPIs have the ability to sell and leave the country. But in the small and mid caps, wherever earnings delivery is there, we continue to strongly believe that incremental flow should be invested in companies which are delivering earnings. So it will remain a stock pickers market. Maybe the market's absolute level may go sideways for some time, given how expensive it is. And as we roll forward to FY26, maybe after Diwali or so. But for the time being, I think in the small and mid cap space, the buoyancy should continue.
Okay, all right. Unmesh, good to have you on the show. I remember, a conversation that we had earlier this year. I think it was around March or April. At that point in time, you weren't very optimistic on consumer staples because of obviously the concerns on growth and the fact that it was very anemic, sort of, a low single-digit kind of volumes that most of these companies were doing. Now the environment is different. Now there's talk of maybe some more populism, at least some more spending on the rural side. Some of these companies have had very good commentary in the fourth quarter result season as well. So what's your sense? And in terms of portfolio stance, is there any shift away from some of the economy-facing names to maybe consumer?
Okay, so look, on consumer, I think, yeah, that was our stance, absolutely right. And it's worked well, interestingly. So, we're quite happy to have that. That has changed a little bit, okay, for three reasons. One is that this is the type of market where if there is a story, even if the earnings are going to be delivered a year or two later, you would still want to kind of play that, it's that type of market. So with the change in the way in which the government went from a single party majority to coalition, and some of the trends that we saw in the elections, we believe that incrementally for the next 5 years, the bottom of the pyramid consumption support will remain important. So from that perspective, rural becomes important. The second is something which we knew already, which is that we are expecting a very strong monsoon. And hence, if you put these two together, what we have done is that we have introduced some rural-facing names into our model portfolio. So it's not a shift really away from government capex, because that I think will continue to remain a big theme. But at the same point in time, taking some money away from cash and some of the things like InvITs and putting them into. We have increased our weight, even though we are overall underweight, but increased our weight on things like Maruti. We have added Britannia, and then V-Mart and so on and so forth. So to play the rural theme.
Okay, so just to follow up on that, you said you've increased the weight on Maruti and added stocks like Britannia and V-Mart to the mix. V-Mart, I guess, yeah, because they have a great footprint in tier 2, tier 3.
There is rural tier 2, rural and tier 2. So it's not necessarily just completely that.
Fair enough, fair enough. So V-Mart makes sense. Just on Britannia, I mean, why, when you're talking top pedigree FMCG, why Britannia?
So look, we do have Hindustan Lever. In fact, interestingly, Hindustan Lever, just because of valuations, actually there was a big gap, which we have cut. So we have come closer to the index, but we still remain 100 pips underweight. But what we wanted is something which is in the index. So Britannia is in there, and we wanted to also have enough market cap to be able to play that. So incrementally, if you look on a relative value basis, that is the one that we've added in there, yeah.
What about IT, Unmesh? That's the only sector that's not doing well today. And it was one of the top performers last week. The index was up 9%. There's also some supply coming in, considering a large promoter stake sale that you've seen in Emphasis today, likely stake sale as well. With macros not changing as much compared to FY24, do you still believe that the guidance that these companies have issued, say for the likes of Infosys and HCL Tech, do you think that is ambitious even with the conservative stance that they have taken?
Yeah, so look, IT, we are long-term believers. We believe that these are all phases when, there is always this confusion about discretionary spend and, shift. It could have been Y2K, it could have been digital, now it is the cloud, and now finally AI. But eventually, they will muddle through and kind of rise to the challenge. Overall, if you look at IT in our model portfolio, we have 100 pip overweight, which is something that we've increased recently to slight underweight. More because of three reasons. One is that there was a relative underperformance and the valuation gap is there. And in the large caps, we believe that relative value is the game in town, given the fact that FPIs are also actively participating. But more importantly, what we do have is that on the IT, is that we have taken out of index and even out of classical IT bets. So what we do is that in our IT portfolio, for example, if you look at out of index, we have Emphasis in there. So among the classical names, so as to speak, and then, Tech M, we are overweight. But we also have things like MCX and TeamLease, which are like, kind of technology enabled, so as to speak. So that's how we are playing this. So services, we are a bit underweight in a sense, but if you look at the entire IT pack, we are overweight.
Okay, so let me end by asking you a very simple question, Unmesh. Given the new era that we are in, Modi 3.0, in your model portfolio. I'm not sure what the top weights are, but let's say what should be the top 5 stocks that everyone should have in this new era now?
Okay, I have to pick up my piece of paper to actually able to answer that. But I think we have, let not be too stock specific, but basically, if you look at large banks, we have the large banks in there. We still believe that in the large caps, we have a relative value in there. We are playing financial inclusion and participation through things like insurance, and we've cut our weight on consumer discretionary. Finally, after being underweight for a long time, we've introduced things like Orient Electric and Crompton Consumer there. So that would be the third. And we continue to remain very positive on the domestic, infra-facing companies. So cement and building materials is another 100 pip overweight. And to round off, I think bottom up, we do like some of the pharma names. We have a new analyst, who's been quite positive on names like Dr. Reddy's and Cipla. So yeah, that's how we round up. These are the 5.
Just a clarification, you've cut weight on consumer discretionary, but you still have Orient Electric, Crompton Consumer. These are still stocks that you like.
No, cut weight as in we were deeply underweight. We've got very less underweight by adding these names in there. We were, through the year, we've been very negative on the consumer. We're kind of changing that now.
Well, Surabhi's questions, simple questions are not so simple after all. But Unmesh, thanks a lot for joining in and spending time this morning highlighting your sectoral and stock-specific preferences as well. That was Unmesh Sharma there of HDFC Securities. Time for a short break here on Trading Hour. Up next, we get you what's buzzing in the commodity space. Manisha Gupta joins us on the other side.
And healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
So the whole debate was whether you should be unloading of PSUs, unloading of capital goods, manufacturing, infra, and moving towards defensives. And we saw that on Tuesday. There was this massive rush for safety. So anyway, let's talk about valuations and how these numbers have absolutely converged. It's been a story, a study in itself. So these are numbers FY26 for some of the prime capital goods stocks. And many of them are, of course, MNC companies. So ABB is right at the top of the pack, 92 times. Hitachi Energy 78 times. And look at the corresponding moves in stock prices. Valuations are up because these have become growth stocks. At one point in time, they were value stocks. But look at the appreciation. Hitachi Energy is up 163%.
Back with us here on Trading Hour, and now time to get you what's buzzing in the commodity space. Manisha Gupta is with us. Manisha, good morning. We're putting the spotlight on precious metals. What's the update there?
Oh, well, yes, we've seen a profit taking. April and month of May were great, stellar months. We've seen gains come in for across commodities as a sector. So whether it was energy or soft commodities or metals for that matter, and precious metals as well. But June has been slightly shaky, and we've seen a definite profit taking coming into this space until now. The biggest trigger until time clearly has been the US non-farm payroll data. coming in the highest in 5 months and easily beating the street estimates, and much on the higher side is where we've seen the numbers come in at 272,000 jobs being created in US. Now that has led to people pushing off in sense of interest rate cut expectations from a nearly 70% probability in the previous week. It stands at 50% probability of a first rate cut coming in for the month of September. The one rate cut that could come in this year, the markets anticipate that would be in the month of November. Now this has led to profit taking in precious metals for sure. Gold prices, after hitting an all-time high at $2,450, are now trading below $2,300 an ounce. We saw 2% of a cut in the previous week, and gold with that is trading at a one-month lows right now. What also is weighing on gold is China's central bank buying, which was absent for the month of May. So China, after buying gold for 18 straight months, has not bought any gold in sense of its central banks in the month of May. And that also has led to some profit taking coming in here. Same situation for silver also, where we saw prices decline 4.5% in the previous week. Here as well, the prices did hit an 11-year highs of $32, but it's trading below 30 right now. So this one also is a one-month lows coming in for silver. For silver, what is also weighing is US imposing 50% tariff on China imports in sense of solar panels. So that has put some pressure here. Also, when you look at the markets going forward from here, it is going to be about the Fed policy decision that comes in on Wednesday. The retail inflation data comes in on Wednesday as well. So these couple of data events, and ahead of that, some jitteriness is what you can expect.
Okay, all right. We'll watch out for that. Thank you very much, Manisha, for the latest. We do have to take a very quick break. We'll come back on the other side. And then some technical trading ideas coming up. And of course, a quick check on the indices as well. They've done really well, 80%, 90% growth in these stocks in the course of the last 1 year. Thermax, 127%. And look at GE T&D, 535%. So valuations on these capital goods names, which are many of them are MNCs, they're ranging anywhere between 50 times, going all the way up to almost 80 times for some of the names like ABB. Now, contrast this with FMCG. FMCG was the original sector that would trade at 70 times. Those were the heydays of the staples era. But now that's changed. So Nestle is the one that's, if these are FY26 numbers, by the way, that I looked at. So about 60, 61 times on Nestle makes it the most valued stock. Godrej comes in at a second at about 50 times. Lever, so these valuation multiples, they've been trending down. Lever itself is at 50 times. They're obviously at a discount to what the historic averages were. Colgate at 48 times. And look at the stock price performance. Lever hasn't moved. I mean, throughout the year. The others are up anywhere between 7-8% to about 11-12%. These have done a little better. Marico, for instance, slightly better. But even here, the valuation multiples have all come down to the 40s, mid-40s. And it's the capital goods space where the valuations have moved up to 80 times. And that's the change that we're talking about. Whether this event that happened, whether that offered a bit of an opportunity for a reset.
He was the man of the week itself, right? He's got close to around 16 MPs, and he was the kingmaker, actually. And who would have thought? Now, there are a few stocks that are moving around based on the so-called Naidu effect. Heritage Foods, he's the promoter entity in there. And, just looking at it, well, the fundamentals as well of the company have been improving, or that's what the street believes as well. So the last year they did around 11 rupees, but the next couple of years, the street believes that it's going to go to 22 rupees. So they believe there's going to be an improvement on ground. Looking at the valuations, even after this 50% move that we saw in this week itself, well, it trades at close to around 31 times. The 5-year average is around 29 times. So in that context, it's not very, very expensive. What is the street factoring in? How come the EPS goes up by so-and-so? They're expecting the value-added products, that was around 30%, to scale up to high 30%. How is that possible? Well, they have been mentioning this, in their con calls as well as in the presentation that they put out. Also, they had some high-cost inventory of, SMP. And out there as well, they are expecting that, in fact, that high-cost inventory will be out of the way. And if you just look at the margins, well, they've come down drastically to around 5% in comparison to around 11% odd. So both of those are the triggers that are going to be working for it. And that's why the margins are expected to improve from here. And that's why the EPS as well is expected to move from here. Well, next up, let's move to Amara Raja. You have Mr. Gala, who was a TDP member. He was also a member of parliament from Guntur. This time around, he wasn't, standing for elections from out there. But in fact, there is that bit of the TDP play, so to call it, for Amara Raja. Besides that, besides the core business, they're also talking about cell manufacturing facilities. And the cell manufacturing facility.
Back with us here on Trading Hour and putting the spotlight on some stocks that are in focus this morning. And one of them is PI Industries, which is under pressure after a key consumer, Kumiai, has lowered its guidance. And Sonal is here to join us with more details. Sonal, what is the guidance that the key customer has given?
Well, they've cut the guidance. Remember, their fiscal year starts from November and ends in October. So that is how we look at the fiscal or the financial year for Kumiai. Now, remember, they had given a guidance in December, and now in the first half, they've cut it by 9% further, citing issues around inventory destocking and global channel as well in terms of agrochemicals business. Now, remember, PI supplies pyroxosulfone, which is active ingredient for Exigo, which is an important product for Kumiai. Pyroxosulfone is the largest export product for PI's CSM segment or the export segment, and there have been questions around pyroxosulfone losing its competitive edge or pricing pressure as well. So this has come in as additional or incremental news flow, which is negative for the company as well. Lower guidance is due to global destocking. The company also speaks about how agrochemicals, the sector is facing an issue, and that continues to be the pain point for PI Industries. The management has alluded to these fears in the past, saying that they are expanding their portfolio and there will not be so much dependence on this particular product itself. However, the issues continue.
Indeed, and the stock is also under pressure now, almost 2% lower. But Sonal, stay on. There is also a buzz of the gas sector being included under GST. What do you have with us on that?
Well, there have been a lot of talks earlier as well. But again, these talks have resurfaced where there could be a possibility of gas coming under GST. In fact, Mahanagar Gas had its analyst meet takeaways where they did indicate that discussions are underway to get natural gas under the GST regime. Comments have been sought by end of June 2024, that is this month itself, on the new central excise bill. Now, remember, right now, the taxation on gas is as under excise duty at 14.5% plus state VAT plus procurement tax. So what happens in this case is on the inputs there's GST, but there's no output GST, which does not allow companies to take input tax credit, and it leads to higher costs for them. But the company says now they expect 12% GST rate on gas, and this could benefit stakeholders across the value chain. And this is similar to what brokerages have been saying as well. Citi, in fact, last week wrote that NDA could consider bringing gas under purview of GST, which could benefit the entire value chain. IIFL says that they believe NDA could consider this in the next 12 months itself. And if that does happen, it could further improve sectoral fundamentals. So that is basically the gas value chain. Jefferies has been very specific. They say government is reviving talks to include natural gas under GST, which could lower the gas cost by $0.8 to $0.9 per MMBTU. Andhra Pradesh, Gujarat, Uttar Pradesh, and Rajasthan are the four largest beneficiaries of VAT on natural gas because that is where we have the major gas fields. Now, GAIL's consolidated EBITDA could rise by 2%, assuming it retains the benefit in the LPG segment. Gujarat Gas's competitiveness would improve versus propane by 6%, and CNG companies should see higher volumes or higher margins depending on whether they pass on the price cuts or not. But if it does happen, it will be positive, but we'll have to wait and watch because previously as well, we have seen such rumors.
Wait and watch, as always has been the case in such issues, isn't it, Sonal? Thanks a lot for both of those updates, actually, on PI Industries as well as on gas stocks as well. But moving on, a couple of other stocks that are also buzzing on the back of earnings and the recent news flow. Vamakshi is here with more details. Vamakshi, which are those stocks?
Well, absolutely, Hormaz. Let's keep an eye out on PTC India. The stock is reeling under pressure today. We pointed out in our top 10 segment as well, and we pointed out that the revenue saw a degrowth of almost 2%. They now stand at 3,216 odd crores. The margins have improved slightly by around 20 basis points from 4.1% to 4.3%. But the net profit has taken a beating, down nearly 47% YOY. And in fact, this is mainly on account of exceptional operating expenses, which came in at 20.5 crores in the fourth quarter, mainly towards surcharge on sale of power. So weak set of numbers coming in from PTC India, the stock reeling under pressure. KC, on the other hand, is surging in trade today after the company announced that they have won new orders worth almost 1,061 crores in their railways, T&D, as well as cables business. And with these orders, the year-to-date order intake now stands at over 3,000 crores, which is an uptick of almost 30%. Railtel Corp is the last one that we will be focusing on. Order wins here as well. They've received a work order for National Informatics Center Services worth almost 81.5 crores.
Okay, all right, got that. So those are a couple of stocks in focus. Vamakshi, also tell us about Suzlon. I mean, there's been so much chatter about the resignation of this one independent director, citing some sort of maybe misses in corporate governance. The stock was slightly lower last I checked, about 4% down. What's the latest on this?
Well, absolutely. Suzlon is reeling under pressure today, and that is because Mr. Mark Desailly, who's an independent director, resigned with effect from June 8, 2024. Now, he has cited corporate governance standards applied did not meet his expectations, including situations where communications lacked his expectation of openness and transparency. Now, keep in mind that he was associated with the company since April 2012 and was slated to, his term was slated to end in September 2024, but he has resigned before that, citing these corporate governance issues. But on the other hand, the management held a conference call yesterday, and on that call they clarified that issues raised were soft in nature and process oriented, and they said that this will be implemented in due course. They, however, highlighted that none of the suggestions revolved around financial or operational irregularities or non-compliance with the law. They reiterated that all legal as well as financial disclosures were fully complied with as far as regulations are concerned. We also have a note coming in from Nuvama on this whole matter, and they say that Suzlon is turning around its financial position, and the operational ramp-up is also expected to come through in FY25. The management is looking to address the needs of the business first, and they intend to implement the best-in-class suggestions in due course. So given all of those factors, they've not changed their rating. They've given a buy rating on Suzlon, unchanged target price of 53 rupees per share. But definitely this announcement does have a bearing on the stock today, and the stock is reeling under pressure.
Vamakshi, thanks a lot for that update on Suzlon. Suzlon has been in focus all through 2023 for the surge that it saw almost through this year as well. It's almost up 30% before today's drop. It's almost a binary, Suzlon. It's either an upper circuit or a lower circuit. It's trying to find a middle ground today. It's down 4%. Closing on levels of 50, and there have been a pretty recent analyst initiations as well on Suzlon. Some of them having targets of 53, 54, one of them even having a target of 60 as well on Suzlon. But today, stock under pressure, down 4%. But moving on then, Samvardhana Motherson is on our radar after Moody's upgraded its credit rating to Baa3 from Ba1 with a stable outlook. Upasana is here with more. Upasana.
Thanks so much for that. Moody's rating has upgraded the credit rating of SAMIL and SMRP, a wholly owned subsidiary of Samvardhana Motherson. The long-term rating of both the companies has been upgraded from Ba1 to Baa3 with a stable outlook. In terms of stock move, the stock has seen an uptick of 6.5% in last 1 month and as high as 57% in last 1 year. Company reported a strong Q4 and FY24 numbers. And looking at the management commentary and outlook of the company has indicated that Europe and North America are 10 to 15% below pre-COVID levels, and emerging markets are driving the growth of the company. FY25 capex plan is 5,000 crores, out of which 2,000 crores will be spent on 18 greenfield projects, and the automotive book business is seen at $84 billion in FY24. 23% of the company's automotive booked business is from EV, and the company is eyeing on newer segments like aerospace, healthcare and medical, and consumer electronics for the growth going forward.
Okay, all right, got that. Thank you very much, Upasana, for the latest on Samvardhana as well. That's favorable news flow, working well for the stock. Let's now go across and say hi to Soni Patnaik, who's joining in. She's, of course, from JM Financial Services. Soni, good to have you on the show today. So some volatility, but the dips are getting bought. What would your advice be on the indices to start off with?
Hey, good morning, Sylvie. Thank you for having me on the show. So if we talk about Nifty today, we can see that it has crossed the previous all-time highs of, and it's quite sustaining above that. Of course, there's a lot of volatility, but from current levels, 23,500, 23,600 is the range, but it can actually test and then see some resistance or maybe profit booking. So if somebody is already holding these levels, then you can continue to hold until you can see the levels of 23,500, 23,550, and just book your profit. So for fresh entry, it's just not quite wise from current levels. Maybe if because the stop loss is not going to be quite intact from current levels, as the support is around 23,100 for now. So for fresh entry, after you've seen the profit booking coming in, just wait for that dip to come again, and then you can reinitiate the longs around 23,100 as a stop loss. Talking about Bank Nifty on similar lines, Bank Nifty has also crossed the levels. However, Bank Nifty from current levels seems to be slightly better than Nifty, and it can test 50,500, 50,700. So I think that's holding quite well with a good support of 49,400 for the day. So I think Bank Nifty is something that can be looked at.
Indeed. What about specific stocks? Sony, what is on your radar this morning?
Good morning, Armaz. So the first stock would be from the pharma space. We're seeing quite good momentum. The stock is Zydus Life. So we've seen a good fresh breakout in Zydus Life. One can buy at current levels, keeping a stop loss of 1,060 and a target of 1,120, 1,125 can be seen in Zydus Life. The second pick is in Indus Tower. So this stock also has seen very good support around 340 levels and continuously moving from those levels. It's defending that support very well. So it is quite likely to test higher levels of 370, 375 from current levels, keeping a stop loss of 340.
Zydus Life and Indus Towers, two recommendations there from Sony. Thanks a lot for that and your updates on the index and specific stocks as well. Time for a short break. Up next, we get you a discussion on ICRA's latest report on why they see a slowdown in the domestic commercial vehicles industry for FY25. Stay tuned. Back on the other side.
Something that is likely to come on stream in the second half of FY26. The capex that they've laid out is close to around 1,200 crores. They're talking about an asset turnover from 1.3 to around 1.4 times odd. So that's going to be the key trigger fundamentally that we're looking forward to. In terms of valuation, the stock has gone up big time, but it still trades at around this 24, 22 times odd. So that's on the valuation chart. Moving to the cement and the infra themes then. The street believes that Mr. Naidu is pro-development. And because he's pro-development, cement will do well, construction as well will do well. So there is that pro-development agenda that's likely to come. And remember, when he was last in the hot seat as the CM, Amravati, that was the capex plan that the street was looking forward to. But when he lost the elections, well, then that complete plan went out of the window. So they're hoping this time around as well, the Amravati big capex plan will come on stream again. And because of that, you've seen stocks like KCP, you have Ramco, Sagar Cement, all of them, well, that's their capacity that they have in Andhra Pradesh as well as Telangana. And that's the percentage of their total capacity. So as you can see at the bottom of your screen, these three companies, in fact, 80 to 100% of their capacities are in this region. So they could stand to gain. The other couple of names, NCCA and KNR Constructions, both of them saw a big rally this week. There are a lot of factors out there, but just to highlight three factors. One is that Amravati capex plan that we're talking about. There were also some pending dues that didn't come about. The street believes this time around they'll get cleared out. So pending dues will get cleared out. And besides that, you have the fresh orders that could come about. So you have Heritage Foods, where he is the promoter entity. Amara Raja, there's a bit of a TDP connect out there, and there's a fundamental reason as well. And cement, as well as infra companies, they could stand to gain. Undoubtedly, the MVP of the last week was Mr. Chandrababu Naidu.
Looking ahead, the result.
Welcome back. Here with us on Trading Hour. We are now focusing on the auto sector. A report by ICRA says that the domestic commercial vehicle industry's uptrend is likely to be arrested in the current financial year amidst moderation in economic activity in some sectors due to perhaps the general elections and some overall slightly tepid trends. We have with us Kinjal Shah, Senior Vice President and Co-Group Head Corporate Ratings at ICRA. Kinjal, it's good to have you on. I was just looking at the note that you folks put out, and you're expecting that for, I think, medium and heavy commercial vehicles, there's actually going to be a decline in volumes, 4 to 7% decline. So where's the sense of caution coming from?
So let me just take a step back and go to some history. So post the pandemic, if you see the CV industry witnessed a sharp growth in volumes in FY22 and 23. So around 26% in FY22 and roughly around 34% in FY23. So this created an enlarged base for the industry. Now on this high base, the growth momentum overall for the industry did witness a slowdown in FY24, and it ended with a 1% YOY growth. And our expectation is that the overall CV industry would witness a decline of around 4 to 7% in FY25, as you rightly mentioned, because of the moderation in the economic activities in certain sectors in the backdrop of general elections. Now, coming to the M&HCV industry, so this industry, which is largely 7.5 ton and above segment, that accounts for around 33% of the total CV industry. And this industry witnessed a flat growth in FY24. And we expect that it will witness a decline of around 4 to 7% because primarily the end user of this segment is the infra segment, primarily the cement sector, steel sector, etc. So here in H1, at least we expect that there would be a YOY decline in volumes because of the slowdown in the infrastructure activities during the election period. H2, we do expect that there would be a YOY growth in volumes. However, our estimate is that the growth in H2 will not be adequate to compensate the loss in H1. And that's why we would see this decline of 4 to 7% overall in FY24.
Kinjal, just to get this right, this is not a high base effect problem. You're saying the moderation in activity and largely because of elections, or is there more to it than the usual, election-related slowdown in ordering?
So typically it's perceived that during the election period that the monthly model code of conduct sets in, and during the election period there is a slowdown in the infrastructure activities, and typically the sectors which are connected to the infrastructure activities that would typically see some slowdown during this period. That's why our understanding is that Q1 and overall H1 that would see a moderation, and H2 we would start seeing a rebound in the activities and thus the growth.
But Kinjal, if you are mentioning that the growth in H2 will not be enough to compensate for the losses in H1, do you believe, is that a continuation of the sluggish trend in demand in general? Because in that case, if there is already a lack of demand in the first half, which is causing the volume contraction, the demand would slightly improve, but still not as much as the first half or as the previous years have been.
Yeah, so typically, I mean, if you see the CV industry is cyclical, and like I mentioned, FY22 and 23 saw very high growth, and FY24 we reached overall volumes at around 9,67,000 odd units, which was just below the peak in FY19 of around 10 lakh units. So the base itself has become very high, and because of that cyclicality, we would see a period of slowdown which would stem in, and this would coincide with this period of the general elections. So both these combined, we expect that would see result in moderation and that growth in FY25.
Okay. Kinjal, just hold that thought. We are just also looking at some numbers that we've got from the mutual fund industry, and that's a massive inflow number. I think the net equity inflow number, 34,670. We've not seen, this is probably an all-time high, by the way, in terms of monthly inflows, because at the peak, these flows were touching 23,000, 24,000 thereabouts. And then there was a decline all the way to just about 19,000. 34,000 is absolutely massive. And it ties in with the other data releases that we're seeing from the exchange level as well, that, retail has been buying, through mutual funds or through direct, but retail has been buying all the dips in the lead up to the election result. And even after the election verdict volatility, we saw it was actually retail buying. And that's a very, very big number coming in on the mutual fund flows. Let's just look at some of the other numbers that are coming through. The flow in the large cap fund category continues to be fairly small. Large caps are not drawing the money, but it is, the mid and large caps, yes, they are getting more of the numbers. Large cap, I mean, yeah, it's increased month on month, but it's nothing compared to the other categories. The mid and large category, the multi-cap categories, they are the ones that are getting, okay, that's a very big NFO number as well. 10,000 crores coming in via the NFO route.
That's a massive number, right? It's 34,000 crores. The mid-cap number also actually 2,600 crores was the mid-cap fund flow, which is almost the highest since November of last year based on what I can see here. So substantial inflows. The mid-caps are drawing the money. The large caps, an increase from last month. But yes, as Ruby highlighted, it continues to remain tepid as compared to mid and small caps. The mid-cap fund flow, there you can see 2605. The number in November was 2666. So it's almost at par with November of last year. So that is some positive data coming in there for the mid-cap. Hybrid fund flows also slightly lower on a month-on-month basis, but mostly flat around 18,000 crores. There were 19,000 crores in the month of April as well. But the overall, the big number is the net equity inflow, which is almost at around 34,000 crores. There, big number coming in.
Absolutely. One of the big launches in the NFO category was the SBI Automotive Fund. And typically, whenever SBI does an NFO, expect large numbers to come in. So a lot of this flow would have been mopped up by that one fund. And there have been other releases as well. The flows are back in the small cap category as well, as Hormuz also pointed out. Mid cap, small caps, they continue to get in the money. Large caps, I mean, contrast the 600 odd crores that's come into the large cap category. It's far, far sort of lower in comparison. So all in all, of course, the SIP number will come with the lag, but SIPs have been very steady, clocking those steady sort of inflow figures of around 20,000 crores on a monthly basis. We'll get that number in a bit as well. But this is looking pretty good in terms of the MF inflows coming in, and a very sharp reversal of the trend of petering flows that we were highlighting over the last couple of months. It's very, very clear that when there was volatility, retail investors decided to go all in, and that's showing up in the equity inflow numbers as well. So more on this as we go along. Once we get the SIP number, we'll have more of a. Oh, by the way, that's an important category as well. Hybrids are constantly attracting a lot of flows, and the industry as a group is focusing a lot on the multi-asset category and the hybrid category. For instance, balanced advantage. I mean, the communication from the industry has been about keeping asset allocation in focus, given the elevated levels that the equity market has been trading at. And it seems that communication is working because hybrids are consistently getting good flows, including, of course, some of the multi-asset funds as well. And also, hybrids, in some of the hybrid categories, the taxation is far more favorable. You manage to get equity taxation because the bulk of the fund is either in equity or in arbitrage, and therefore the whole thrust is to look at hybrids as a very tax efficient way of taking exposure to both categories, I mean equity and debt.
Having the best of both worlds, I guess, in terms of the hybrid funds, right? Almost 18,000 crores, not a bad number. It's still lower month on month, but still almost on at par with the flows in April. But there you can see the large cap, the main fund flow, the 34,000 crore number is the highlight of this release from AMFI. There, it's a record high, 34,671 crore as we speak. So, but we'll get more reactions as we get the SIP number as well. But we go back to Kinjal with our conversation. Kinjal, thanks a lot for staying by and being patient with the numbers that came out from AMFI. Oh, we get back to that as well. So the small cap funds there, 2,700 crores, the flows there as well. So numbers picking up for the small cap funds as well. They were a bit lower towards the month of March. They had seen some outflows. Then they had picked up in April at around 2,200 crores. Now they're at 2,700 crores as well. So mid and small caps continue to see healthy funds, but overall the main inflow number is the big one.
The other category, which is getting a lot of steady flow, is flexi cap. By the way, this month, in the reporting month of May, flexi cap funds have gotten more money than large caps, mid caps, or small caps, the individual categories put together. So again, the narrative that allowed the fund manager flexibility to go across market capitalization, depending on where the fund manager finds good value at that point in time, looking at the market's construct and structure. That seems to be working, because 3,155 crores have come into the flexi cap category. Sectoral and thematic funds. Yeah, look at the giant surge over here. 19,000 crores have flown into sectoral and thematic funds. A lot of that, I mean, as I explained, one of the big funds was this automotive fund coming in from SBI. But in general, a lot of thematic launches are happening, because remember that mutual fund houses are restricted. They can only have one fund per category. So if you have large cap, there can be one large cap fund, one mid cap fund. But you can have as many as you want in terms of sectoral and thematics, newer niche sort of themes on which fund houses can launch products. And that's what's happening. I mean, there's been a huge push on the sectoral and thematic category. Let's take a break. We'll try and get you some more perspective on these numbers as we go forward, but looking very good in terms of equity inflows for mutual funds in the month of May. Back in a moment.
continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability.
Welcome back. You are with us on Trading Hour, and let's just look at the market as well. The market's holding steady, about 50 points high, not much has changed. So the Nifty continues to look at some green. The mid-cap index actually is absolutely in sync with the Nifty today. And the Bank Nifty also not too far behind. Bank Nifty is up about 0.3%. So for change, you've got all the indices absolutely at par and in sync. And there you have the big visuals coming in from New Delhi, the visuals that everyone's been waiting for. Prime Minister Narendra Modi taking charge for the third consecutive role as India's finance minister, only second person to have that honor after Mr. Jawaharlal Nehru. So there you see the shots of Prime Minister Modi taking charge. Now, of course, the much awaited release on the portfolio allocation. That is what everyone's really waiting out to know who gets which portfolio, and of course, where will or who will head the key ministries like finance, like corporate affairs, and so many others, home, etc. I mean, many important ministries. So we are waiting for the portfolio allocation to come in now that the Prime Minister has taken charge. So maybe we should have that also in just a bit. Okay, as promised, let's get back to those numbers coming in from AMFI. We have Abhishek Tiwari, Executive Director and Chief Business Officer at PGIM India Mutual Fund, joining in. Abhishek, great to have you with us. So that net equity number is massive. It's gone above 30,000 crores this time around, right? And that's a huge jump, considering we were in a bit of a declining trend so far this year. What do you think has gone behind it?
Oh, first of all, thank you for having me. I think what has gone behind it is the linearity of returns that continues to follow. I think we haven't really seen a trend which is one way down. But having said that, I think it also, in a manner of sorts, shows the evolution of the investors, where for every dip there are new buyers. When you look at the folio numbers behind these, absolute sales numbers, you will realize what I'm talking is what is making sense. And in addition to that, I think the sectoral and thematic, stories and the narratives which are adding up to what is happening at the broader economy is clearly being able to drive the sales up.
Abhishek, good morning. Thanks a lot for joining in. The large cap funds, they may have picked up from the month of April, but they still remain pretty tepid in comparison to the mid caps and the large caps. There's a lot of consensus on the street going on that the large caps are the ones that offer more value compared to the mid and small caps, but the flows are suggesting completely otherwise.
Yeah, so I think there's always going to be that tussle between shorter term trends and longer term performance. The shorter term trend clearly suggests that the value available in the large caps versus the segment of the market which is small and mid cap, which has done a stellar run over the last 12 to 18 months in specific, clearly offers a lot more value. And I think as a fund house, we have been out there saying the same thing for over 6 months now, if not longer. So clearly there's more value when you think of looking at that segment from a risk return in the near to the medium term. But having said that, obviously the longer term picture, because of the 18 and 24 months performance in small and mid caps and also the thematic funds, is clearly painting a different picture for the investor.
Yeah, exactly. I was just coming to thematics because Abhishek, this is an eye-popping number. I don't remember ever seeing an inflow of 19,200 crores in thematic funds. Some of this would be because the NFOs are thematic in nature, right? I think SBI's, NFO was the auto sector NFO. But again, yes. What further intelligence can you share with us on this huge number and the trend? More importantly, because the purists will say that handle thematics will care, don't go overboard with thematics in your portfolio. But these numbers are absolutely, gravity defying.
So what you're saying is totally making sense. I think the numbers in itself is a departure from any of what any of us would have expected. Having said that, the fact is that it also shows, and this is more so how we are thinking about it, when we draw up our plans. The breakup is important to understand. One is that clearly some of these themes, some of these sectors have a far larger representation than it used to have earlier, combined with the fact that the policies and reforms are really been something at the back of every investor and every investment manager's mind, where they have more confidence in terms of backing these themes. Combine that to the fact that the investor in itself has evolved. And let me qualify that statement by first of all saying a large part of it is driven by the returns